Welcome to the CFA Level 1 presentation on security market indices. So let's start with the fundamental question, what is a security market index? So essentially a security market index is a combination or a collection of securities that effectively represent a given market or a given segment within a market. Some of the most well-known indices in the world are the Dow Jones Industrial Average, the S&P 500 Index, the Nasdaq Index. So these are some of the best known indices in the US. In the rest of the world, you have indices such as the Nikkei that represent the Japanese stock market, the FTSE that represents the British stock market, and so on. In Pakistan, the most well-known index is the KSE 100. What are the issues to consider when we construct an index? So essentially, how do we choose what shares to put inside this index? The first thing we need to look at is what is being measured. So let's say that we want to construct a new index that measures the performance of banks in Pakistan. Now, if that's what we want to measure, this is the first thing to identify when we are constructing a index. So we need to look at what's being measured, and let's say we want to measure the performance of publicly traded banks in Pakistan. Then we have to decide what, based on this objective, what securities should we include. Clearly we need to then include securities of banks in Pakistan. So now we might decide, for example, to include MCB, UBL, HBL, National Bank, etc. So we have to decide which ones to include. We might decide just to include the biggest ones, or we might decide to include all the publicly traded banks, and so on. But clearly some thought process has to go into which particular banks to include. We then need to decide that, let's say that we make a simplistic decision that we just want to include these top 4 banks. Then the next question is, what are the weights in the index? So if we create an index with these 4 stocks, should we have every stock have equal weight in the index, or should we say that since MCB has the highest market capitalization, this should have the highest weight? So clearly there is some thought process that needs to go into the weights. How often to rebalance means that if we need to change the weights from time to time, how often should we do that? And finally, we should also have rules in place on when to reconstitute. So reconstitute means changing a security in here. So if at some point we feel that we want to take out, so we might say that every 6 months we review and look at which securities to keep, which not to keep. So if our rule earlier on was the 4 largest banks measured by market capitalization, then every 6 months we'll see whether these 4 are still the banks with the largest market cap. If not, if say UBL loses some market capitalization and let's say Mizan Bank becomes the 4th biggest bank, then we kick out UBL from this index and stick in Mizan Bank, just as a example. Another point related to security market indices is whether the index is a price return index or a total return index. The idea here being that if we are measuring, let's say very simplistically put, that in a given year, say 2010, let's say that on average all these prices went up by 20%, and let's say that the dividend paid on average was 2%. What this means is that if this is a price return index, then the index will go up by 20%. If this is a total return index, then we look at not just the change in price but also the dividend. So then the total return will go up by 22%. So now let's talk about the different ways of weighting an index. There are going to be 4 methods that we'll talk about, and remember this refers to different ways in which we weight the four securities in the bond in our index. So let's take a very simple example. Let's say we create an index with 3 stocks, A, B and C. In a price weighted index, the weightage happens based on the prices. So let's take a situation where we in let's say 2009 we start the index. So at the start of the year, let's say A has a price of 100, B has a price of 50 and C also has a price of 50. The way we will create an index here is we say that the index value at the beginning of 2009 is 200 divided by 3, which is equal to 66.67. Then 1 year later, let's say that so 1 year later, let's say that A goes up by 50% and B goes up from 50 to 55, and let's say C stays the same. So notice that the stock with the largest weightage, because the weightage here is based on stock price, so that went up a lot, whereas the lower weight indices did not go up by as much. So what is our new index? Our new index is 100, 200, 255 divided by 3, which is 85. So our index went up a lot because the heavyweight stock, given that the weightage is based on stock price, since that went up by 50%, that had a huge influence on the index. So that highlights a potential issue with doing price weightage, which is that the changes in index are heavily influenced by shares that have a high price. Now this share might have a high price, but it might have a very low capitalization because the number of shares outstanding might be low, but that does not matter over here. Is this a price return versus the total return? The example that I have illustrated here is actually a price return because we have only looked at changes in price. We did not even consider dividends. On the other hand, if on average these shares gave, let's say the weighted average based on price, these shares gave a dividend of 2%, and we include that 2% dividend in the index value. So if the index value, instead of going up by this percentage, we also factor in the impact of dividends, then this would be called a total return index. There are some nice examples in the curriculum. I am not going to go over them right now, but just the main point for you to understand is, if we are simply looking at, if the index price is simply reflecting the stock prices, then this is a price return index. If the index price is also reflecting the total return, then this would be a total return index. And to give you an example, the Dow Jones is one of the most famous price weighted indices in the world. It is based on 30 of the largest stocks in the US, and this is a price weighted index, so dividends are not accounted for. How do we deal with splits? So let's say that stock A does a 2-for-1 split. So what that implies is that instead of 150 now, the price of A becomes 75, and let's say that the price of B and C remains the same. Now what should the index price be? Given that there is no economic change, so somebody who owned this index or owned the underlying shares even in the same weightage, after the split, that person still is no richer or no poorer. And since there is no economic change, the market index or the security market index should remain unchanged. And how do we account for that? We do so by changing the denominator. Notice that now the value of the index, if we just, or the sum of the share prices now is 180. So we need to decide what to divide 180 by in order to get 85. The answer is 2.12. So essentially what we do is change the denominator. If the denominator pre-split was 3, post-split the denominator is 2.12. So key point is that the index value, the index number is not impacted by splits, but the denominator used in the calculation is. I mentioned that the Dow Jones is a price weighted index. When the Dow Jones started with 30 shares, the denominator was 30, and today, many years later, there have been several splits. So the denominator now is a very small number. I don't remember what the exact number is, but it's much less than 1, and that is because every time there is a split, the denominator goes down. Next, let's talk about an equal weighted index. So in an equal weighted index, if you have A, B and C, then the weightage of all three stocks is the same. So if we go with the example that we just talked about, we had a situation where stock A was 100, stock B was 50 and stock C was 50 initially, and if A increases from 100 to 150, B goes from say 50 to 55 and C remains the same, then with an equal weighted index we assume that an investor has put an equal amount of money in each. So he is not concerned with the share price. What he is concerned about is the return on each share. So notice that the return here, 50% for A, for B the return is 10%, for C the return is 0%, and for an equal weighted index we basically take the average return. So the average return 50, 10 and 0 is 60 over 3, which is equal to 20%. Compare this with the return from our previous example, where if we look at the return in the previous, we went from 66.67 to 85. So here the return is 27%. So here we only have, so with equal weighted we have 20%. In a price weighted the return was 27%. Why does the price weighted return, so why do we have a higher return if we are weighting based on price? That is because the impact of the high price share is much more when we do a price weighted index. When we do a equal weighted index, then it doesn't matter what the share price is. All that matters is the return on each stock in the index, and then we simply take its average. So that's an equal weighted index. Now, is this a price return or a total return? The answer here again, what I have calculated is a price return, because we are simply looking at the change in prices. If there was an average dividend of 2% on all these stocks, then the total return for the index would have been 20 plus 2, which is equal to 22%. If this was more realistic, then we would actually calculate the total return using both capital gains and dividend for each of these shares, and we would then take the average of those total returns. Next, let's talk about the market capitalization weighted index, and this is probably one of the most popular methods for weighting the different stocks in an index. Now, how does this work? So here we weight based on market capitalization. So if you have again stocks A, B and C, and we go with the same prices, we look not just at the price, but we also look at the shares outstanding. So if A has 1 million shares outstanding, B has 50 million shares outstanding, and C has 10 million shares outstanding, then we look at the market capitalization to do the weightage. So the market capitalization for A would be 100 million. The market capitalization for B would be 2500 million. The market capitalization for C would be 500 million. So the weightages of the three shares would be based on market cap, and the heaviest weightage now would be for stock B, and A now will have a relatively low weightage. So this is important to understand. And what is the concept of market float? What this is saying is that sometimes, rather than considering the number of shares outstanding, we actually look at the number of shares that are available to the investing public. And an example might be that if with share B, let's say 10 million shares are owned by the founding members of this company, and those shares are not being traded. So rather than use 50 million, we will use 40 million. So that would called a market capitalization weighted index, where we are only using the market float. So key point here is that weightage is based on market capitalization rather than the share price, or rather than equal weightage. The fourth and final way of weighting is called fundamental weighting. Here the weight is based on a fundamental attribute such as earnings. And let's say you have two companies, A and B, both have earnings equal to 20 million. A has a market capitalization of 200 million, B has a market cap of 800 million. With fundamental weighting, both A and B will have a 50% weight in the index. So what this is saying is, if A goes up by 10% and B goes up by 20%, then our index will go up by 15%. On the other hand, had this been a market capitalization based index, then A would have a weightage of 20%, B would have a weightage of 80%, and given the same, so these are the weights based on market capitalization. So given A going up by 10% and B going up by 20%, how much would the index go up? The index would go up by 0.2 into 10% plus 0.8 into 20%, which is 18%. So notice that with a market capitalization based weightage system, we give a much heavier weight to stock B, which has a higher market capitalization, even though B has the same earnings. So another core point here is that notice that A is a better value stock. Why? Because for 20 million of earnings, A has a market capitalization of 200 million. So A's price earnings ratio is 200 over 20, which is, so A's PE, price earnings, is 10, whereas B's PE is 800 over 20, which is 40. So in a fundamentally weighted system, A, which has a much better value, in other words a lower PE, gets a relatively high weightage compared to the 20% weightage in a market capitalization based index. And this is why we say that with with a weighting system that is based on fundamentals such as earnings, those indices will have a value tilt. Value tilt means higher weightage for stocks which have a better value. In other words, price is low relative to a certain fundamental attribute such as earnings. From an exam question perspective, there's a high probability that if there is something related to fundamental weighting, the key concept is that indices with a fundamental weighting have a value tilt. Rebalancing and reconstitution, you just need to know the meanings of these terms. So rebalancing simply means adjusting the weights of constituent securities. Notice that with price weighted and with market capitalization weighted, we don't really need to worry about rebalancing, because when price changes, then automatically the weightage adjusts. Similarly, if the market capitalization changes, automatically the weightage adjusts. So where we really need to worry about rebalancing is with equal weighted indices. So that's critical. So with equal weighted indices, when prices change, then the weights go off. So then you need to make an adjustment, and that adjustment is called rebalancing. Reconstitution, which I talked about earlier, simply means changing the constituent securities, and for any index there will be a time period such as 6 months. So every 6 months we need to go back and see whether we need to make any changes to the securities that make up our index. So the example I gave earlier is, let's say that in this index we have 1, 2, 3, 4, 5 stocks, and you are picking the 5 biggest stocks or the 5 biggest market cap in a given sector. So if the stock 5 now goes down in number to 6 and another stock takes its place, then you need to do some reconstitution. Uses of indices. Number 1, they help you gauge market sentiment. So if we take, say, the KSE 100, the performance of the KSE 100 is a good indicator of the market sentiment in Pakistan. So if the KSE 100 is going up, that means the sentiment is positive. When it goes down, that means the sentiments are negative. Indices are proxies for measuring and modeling returns, systematic risk, and risk-adjusted performance. Here, if you recall from our earlier lectures, how do we calculate beta, which is the systematic risk for a security? The way we calculate beta is we look at the returns of a given stock or portfolio relative to the return of the market. Now, what is the market? The market typically, the proxy, the best proxy for the market is an index. So when we have an index as a proxy for a market, it makes it possible for us to calculate the systematic risk of stocks and portfolios. The indices are also proxies for asset classes in asset allocation models. What this means is, so let's say that in Pakistan, if we talk about the equity asset class, so a given investor wants to put 60% of his money into equities. What does that mean? One simple thing to do is to simply take 60% of your client's money and put it in the stocks that are in the KSE 100. So the KSE 100 essentially provides a proxy for the whole equity asset class in Pakistan. Indices are also benchmarks for actively modeled portfolios. So if a given investment manager thinks he can do a good job of picking stocks, how do you figure out whether he is really doing a good job or not? What you can do is compare his returns with the returns on the KSE 100. If he consistently beats the KSE 100, that means he is doing a good job of active portfolio management. If not, then he isn't doing a good job of active portfolio management. Indices also serve as model portfolios for an index fund and exchange traded funds. So if you want to create an index fund or an exchange traded fund that reflects the equities in Pakistan, then you simply follow whatever or buy the shares in the KSE 100 index. There are indices for equities, fixed income securities, as well as alternative investments. So just a few core points. When we talk about equity indices, you need to understand what we mean by broad market indices. So the KSE 100, for example, is a broad market index that reflects the entire, that sort of is a reflection of the entire Pakistani stock market. So the way the KSE is constructed, it includes representatives of representative stocks from all the major sectors in the economy, and hence KSE would be called a broad-based index. If we create another index which is simply focused on the banking sector, so that is not a broad-based index, that would be called a sector index. So sector indices help determine whether active investment manager is more successful at stock selection or sector allocation. Let me just explain this phrase because it's important. So let's say that you have a given investment manager who focuses on investing in the banking sector. So how do you determine whether that investment manager is doing a good job of picking stocks in the banking sector? What you can do is simply look at the return on the banking index versus the return of the stock manager who is picking stocks in the banking sector. If the stock manager does better than the index, that means he is successful at stock selection. If not, that means that he is not so good at stock selection. So if a manager is not good at stock selection, the better thing to do would be to simply allocate. So let's say if we are allocating 40% of a investment portfolio to the banking sector, then if we are not good at stock selection, it just makes sense to allocate to the sector, and when we allocate to the sector, we should just buy the shares in the relevant banking sector index. A multi-market index is one that reflects multiple markets. So you can have an emerging market index that is essentially a combination of indices from various emerging markets such as India, China, Pakistan, etc. So that would be an example of a emerging market index. Typically, the relative weightages in the emerging market index of different country indices would be based on the GDP of each of the countries. We can also have style indices. So we can have an index that only reflects different types of market cap. So you can have a large market cap index which consists of stocks that have very high market capitalization. You can have small market cap indices such as the Wilshire 5000, which is an index consisting of stocks that have small market capitalization. Value refers to value versus growth. So value stocks are generally stocks with relatively low growth, with relatively low PE ratios. So if a given investment manager only focuses on value stocks, you compare his performance by looking at an index which is only made up of value stocks. So that would be called a value index. A growth index is one which has stocks that have relatively high growth. So if a given investment manager focuses on growth oriented stocks, then his performance should be compared to the index of to essentially a growth index. We can also have mixed indexes. So you can have a large cap value index. So this is saying that this index has stocks which are large cap and which are value stocks. So there is a whole range of combinations, but as long as you understand what I just said, then the basics are covered. Fixed income securities. This is a complicated area, but you just need to understand a few points in order to be able to answer questions on the exam. The most important point related to fixed income indices is that they are challenging or very difficult to construct. Why? Because there is a very large number and variety of fixed income securities. The government alone issues a large number of securities, and then every company might just have one stock but a whole host of fixed income securities. And then many fixed income securities are not liquid. So in Pakistan, for example, corporate bonds are called TFCs, and these bonds exist but they are not very liquid. So if they are not very liquid, pricing information is not easily available. If the pricing information is not easily available, then obviously that makes it challenging to trust the values shown by the corresponding index. So what you need to know is that these are two major reasons why it is challenging to construct a fixed income index. Next point is that you need to be aware of the fact that there are some aggregate fixed income indices, which basically, for example, you might have in the US a fixed income index for the corporate sector. So that would be an aggregate index, but then this can be divided by market or economic sector to create more narrowly defined indices. So you could have a corporate bond index, and then within that corporate bond index you can then define it as various economic sectors such as pharma or technology and so on. So the last point related to fixed income indices is that you can also have indices based on the type of fixed income. So there are different types of fixed income indices. One would be based on the type of issuer. So you can have an index for government bonds versus corporate bonds. Currency, you can have dollar bonds, euro bonds, yen bonds. You can have indices based on bonds which have 5-year maturity, 10-year maturity, and so on. Credit quality, you can have bonds for companies that have a AA plus rating. You can have index for bonds that have BBB rating, and so on. So that's it in terms of fixed income securities. And finally, alternative investments also have their indices, where there are indices for different kinds of alternative investments. We can have commodity indices, but the challenges with commodity indices are that commodity indices are generally based on futures markets and not on the spot markets. Hence, and another issue is that different indices might use the same commodities but different weights. So the performance of an index can be different from that of underlying commodities. The key reason for this is actually the first one. Because indices are based on futures markets, it is possible that futures prices are moving somewhat differently from spot prices, and hence price changes in the spot market might be different from the price changes in the futures market, and hence the index might not necessarily move with the spot prices of the underlying commodities. With real estate indices, you need to know that first of all, real estate securities, the big issue is that they are not very liquid. So creating a real estate index is not easy because the underlying components or constituents of the index are not liquid. Nevertheless, we do have real estate indices, and you simply need to remember that the major types of real estate indices are appraisal indices, repeat sale indices, and REIT indices. REIT stands for Real Estate Investment Trust, and very simplistically put, these are like a mutual fund of real estate investments. We will see this in detail later, but briefly the idea being that investors pool their money, and that pool fund goes to buy a portfolio of real estate investments, and REIT companies then issue shares or stocks or units, and those units, their pricing is based on the value of the underlying real estate investments. So these actually, of the various kinds of real estate investments, these are the most liquid, and hence we have a lot of indices based on REIT prices. Hedge fund indices, since hedge funds are not regulated, every hedge fund voluntarily contributes its information to the index provider. So what that means is that there is voluntary reporting of hedge fund returns. As you can imagine, only the best hedge fund performers are likely to report their performance, and since the contribution is voluntary, the constituents, which is the hedge funds, rather than the index provider, determine what goes in the index. Just to make this distinction clear, when we have, say, the KSE 100, The entity that creates this index decides which 100 shares go in the KSE 100. But an entity that produces an index provider is constrained because it can only include hedge funds that voluntarily provide their information. The hedge funds that are providing their information are the constituents of the index, and it is those constituents that are effectively deciding what goes into the index. And for these reasons, the hedge fund returns are going to be upward biased. From an exam perspective, this is the critical point, that generally hedge fund returns, or the indices, the returns of hedge fund indices are upward biased. So that is it. Again, I just went over the core points. It is essential that you go through the curriculum and practice all the questions there, as well as practice questions from your study notes, and that is it.